Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, $182 billion in debt fuels a data center frenzy as US hyperscalers create a massive AI infrastructure gap with Europe. So we'll discuss why this turns critical infrastructure into a speculative asset and what it means for Europe's competitive future. Second, TikTok's US deal is done, but ByteDance keeps a 19.9% stake, creating a new model for a fragmented global internet. We'll analyze why this divestiture is a turning point and how it could create a playbook for other nations to fragment the internet. Third, Hollywood races into the $7 billion microdrama market, betting on a freemium model that turned Quibi's vertical video failure into a success. Today, we'll take a closer look at this new content model and its implications for how AI is reshaping Hollywood storytelling. Fourth, new solid-state power banks use semi-solid-state batteries to solve the fire risk, plaguing millions of devices, promising 2 times the longevity. This discussion will reveal how this power bank is a test bed for EV battery tech and what it means for future safety regulations. Fifth, a SpaceX Starlink satellite explodes in orbit, shifting the Kessler syndrome threat from rare collisions to frequent mega constellation failures. We'll examine how this failure creates a new Kessler syndrome risk and what it means for the future of space-based internet. Let's start with a statistic that might just change your entire perspective on AI infrastructure. Debt issuance for data centers has nearly doubled in just 1 year, exploding to $182 billion. A while back, we walked through those trillion-dollar AI build-out ambitions from the biggest players. Well, today's surge is the financing engine, making that arms race real. Behind that number, the tech giants, or hyperscalers, are strategically shifting the immense financial risk of building these facilities off their own balance sheets. By using debt and private capital, they can expand at lightning speed without taking a massive immediate hit to their own books. And as we've discussed before, the end game is to turn that infrastructure into locked-in, predictable revenue. And the biggest names in tech are leading the charge. Meta has raised $62 billion in debt since 2022, with nearly half of that coming this year alone. Google and Amazon have piled on another $29 billion and $15 billion respectively. Here's where it gets interesting. In what S&P Global calls a global construction frenzy, these hyperscalers aren't just funding this expensive expansion themselves. They're increasingly tapping private equity markets, a trend that has some investors questioning the real value of these advanced tech hubs. This shift signals a fundamental change in how our digital world is built. We're seeing the rise of a new landlord class for the internet. Private equity firms are buying up data center operators, with some reports showing they've accounted for 80 to 90% of all data center deals since 2022. This turns critical infrastructure into a speculative real estate asset. As we flagged a while back, analysts are drawing parallels to the dot-com bubble when overinvestment in dark fiber led to a massive bust. And they're asking if the same could happen here if AI doesn't pay off as fast as everyone hopes. The market is on a knife's edge. When a report surfaced that a single $10 billion data center deal involving Oracle might be cancelled, the company's stock dropped 5%. It also sent ripples through the market, pulling down giants like Broadcom, Nvidia, and AMD, and giving the Nasdaq its worst day in nearly a month. We previously noted Oracle's revenue wobble and rising costs to insure its debt, a sign of growing nerves. So this latest rumor fits a pattern we've been watching. Despite the jitters, total deal making still hit a record $61 billion this year. A few days ago, we mentioned how 9-figure enterprise AI deals are finally showing up, fuel that keeps capital flowing even when headlines get choppy. The competitive landscape is brutal, with a recent report predicting data center investment in the US could be 5-fold higher than in Europe, leaving the continent in the dust. This isn't just about one country getting more buildings, it's about a growing AI infrastructure gap. The US currently holds about 53% of the world's hyperscale data center capacity, while all of Europe has just 16%. Europe's stricter regulations and high energy costs are slowing them down, which could impact their long-term digital sovereignty and economic competitiveness. This all leads to a powerful prediction from one S&P Global analyst. He says he wouldn't be surprised if already high valuations get even higher. The reason? A lack of energy supply could slow down new construction, making the data centers that are already built even more valuable. And there's a physical limit to all this. We're talking about a single large data center campus demanding as much power as a small city. One forecast from Gartner projects that global data center electricity consumption will more than double by 2030, with AI being the number one cause. And as we've discussed a while back, it's not just electricity. AI data centers are copper hungry, roughly 20 to 40 tons per megawatt for next-gen liquid-cooled builds, with a single hyperscale campus reaching tens of thousands of tons. Inventories on the London Metal Exchange have been sliding, and new mines take decades to bring online. So, the power grid and raw materials, not just chips, could become the primary bottleneck on the future of AI. From the high-stakes world of infrastructure finance, let's shift to a geopolitical chess match involving the world's most popular app. The TikTok sale is finally done, but the biggest bombshell is who Times isn't time selling. After all the pressure to divest, TikTok's parent company, ByteDance, is keeping a nearly 20% stake in the new US business. That 19.9% stake is, unsurprisingly, raising a lot of eyebrows. Some national security experts are asking if this deal truly severs Chinese influence, or if it's just a form of security theatre. The structure is designed to appease regulators, but questions remain about how much de facto control ByteDance and its core investors might still have. A while back, we walked through how the new law turned informal jawboning into a legally backed threat, a kind of executive kill switch. This new joint venture is what compliance looks like under that pressure: restructure or risk a shutdown. So here's the breakdown of the deal that just dropped. A new company, TikTok USDS joint venture, is being formed. A consortium of American investors, including Oracle, Silver Lake, and MGX, will take a controlling 50% stake. And you might be asking, who is MGX? It turns out it's a brand new Abu Dhabi-backed AI investment fund chaired by the UAE's National Security Advisor. So while the deal addresses concerns about a Chinese-linked entity, some argue it simply trades one set of geopolitical and data security questions for another. We've said before the national security frame doesn't disappear, it just shifts where the leverage sits. But that's not the whole picture. The real turning point is that affiliates of ByteDance's existing investors will hold another 30%, leaving ByteDance itself with that 19.9% slice. This entire deal is a high-stakes answer to the US divest or ban law. The core conflict has always been about control, and the new US joint venture is designed to seize it. We previously analysed how Washington's leverage expanded from hints to hard law. This development is that playbook in action. Now, here's where the situation takes a more complex turn with global implications. By forcing the divestiture of a foreign app, the US may have just created a playbook for other nations. What's to stop the European Union, India, or Brazil from citing their own national security or digital sovereignty concerns and demanding that American tech giants like Meta or Google create similar joint ventures with local partners? This could be a major step toward a more fragmented global internet. We said a while back that the US had effectively handed the world a legal blueprint. Remember India's 2020 TikTok ban? Today's twist is that the blueprint now includes a recipe: force a local JV, segregate data, and claim sovereignty over the algorithm. That's the digital iron curtain we've been tracking, one layer thicker. It will be responsible for all US data protection, content moderation, and software assurance for over 170 million American users. But the most audacious part of this agreement is the promise to remake TikTok's brain. The new company will oversee the retraining of the powerful content recommendation algorithm using only US user data. Actually, remaking the brain is incredibly difficult. The process is called forking the algorithm. The original AI was trained on a massive global data set, and by retraining it on only US data, you lose all that diversity. Research from institutions studying machine learning suggests that models trained on smaller regional data sets often suffer in performance. For you, the user, this could mean a less engaging, less eerily accurate For You page. And as we warned before, when governments can dictate these levers, the risk isn't just foreign manipulation, it's state influence over public discourse. The stated goal is to ensure the feed is free from any outside manipulation. To enforce this, Oracle will not just be an investor, it will become the trusted security partner, auditing and validating that all national security terms are met. In other words, it's the marketization of that kill switch era. A structural threat turns into a service contract. Believe it or not, this could be the birth of a whole new business model for cloud providers. Think of it as national security as a service. Oracle is positioning itself not just as a data host, but as a geopolitical security auditor, a role that could give it a huge advantage over competitors like Amazon Web Services and Microsoft Azure in the fight for high-stakes, politically sensitive contracts. The agreements were signed pursuant to an executive order by US President Donald J. Trump with a target closing date of January 22nd, 2026. The final result is a radical restructuring of the world's most influential app. A new American-governed TikTok is being born, firewalled from its global operations and watched by a US tech giant, all while its original Chinese creator retains a significant piece of the very company it was forced to sell. Continuing our earlier theme, the platform survives, but inside a tighter political perimeter. Speaking of how platforms are evolving, there's a revolution happening in the content itself. An entertainment market that barely existed 3 years ago just exploded from $500 million to $7 billion in revenue. And now Hollywood is in a frantic race to get a piece of the action. We're talking about microdramas. These aren't your typical TV shows. They're 60 to 90-second episodes shot vertically for your phone with titles like Fake Married to My Billionaire CEO. While Hollywood first dismissed them as a joke, the numbers became impossible to ignore. The global market is now projected to hit $16 billion by 2030. What makes this work is the Western adaptation of China's hugely successful Duanju, or short drama market. The low-budget vertical video style feels native to social media feeds, making it more relatable and authentic to users scrolling through TikTok or Instagram, unlike polished, high-budget Hollywood productions. But if that was just the appetizer, the main course is just being served. After standing on the sidelines, industry giants are making their move. Disney is backing a microdrama company in its accelerator program. Fox just invested in a platform with a commitment to make over 200 new shows, and major players like Paramount and Lionsgate are now striking deals to get their content on these apps. However, Hollywood has tried this before and failed spectacularly. Remember Quibi, the quick bite platform that burned through nearly $2 billion in funding and collapsed in 6 months? So why is this time different? The answer reveals a fundamental shift in how we consume media. Quibi asks you to pay a monthly subscription like Netflix for high-budget, star-studded shows. It failed because it was trying to be TV on your phone. These new apps, like Real Short, learn from that mistake. They use a freemium model. You watch the first few episodes for free, but then you hit a cliffhanger. To see what happens next, you can either wait 24 hours or pay a small fee, maybe 70 cents, to unlock the next episode immediately. It essentially transforms storytelling into something that works like a slot machine. The model incentivizes writers to create manipulative cliffhangers, not necessarily coherent stories, using psychological tactics like variable rewards and compulsion loops to keep you paying. It's less like a movie ticket and more like dropping coins into an arcade game, and it's wildly effective. One platform saw a 992% increase in downloads in a single year, rocketing to over 37 million users. The answer is desperation. One industry journalist says Hollywood is going through a real moment of transition and everyone is searching for the silver bullet. With shrinking budgets and fewer jobs, these low-cost productions are being seen as a lifeline. And here's how the industry is adapting. The main actors union, SAG-AFTRA, has actually created a new verticals agreement. It's a special contract for these micro-budget shows, aiming to get union protections for performers in this new, rapidly expanding and previously non-union space. It's a sign that the establishment is taking this seriously. Even Anthony Zoica, the creator of the blockbuster TV franchise CSI, is now writing microdramas. He went on the record saying, "I see the failed broadcast model. I know the challenges of streaming and cable. Why wouldn't I want to be in this space?" Interestingly enough, some see this as a return to an older Hollywood model. Think of the low-budget independent films of the 1960s, which gave starts to legends like Jack Nicholson and director Roger Corman. This could be a new farm system for undiscovered talent. And here's a wild card: artificial intelligence. Some of these new platforms are using AI to analyze viewer data when you pause, rewatch, or stop watching to identify popular tropes and tell creators what kind of stories to make. The algorithm is effectively becoming the new studio executive, greenlighting shows based on data, not just intuition. The core conflict is clear. Can Hollywood turn this low-budget, sometimes salacious format into premium entertainment? Or is this a repeat of the Quibi disaster? Zuika is betting it's the future. He predicts that in just a few years, microdramas will be at the forefront of consumption, just like streaming and cable once were. While Hollywood is betting on low-budget content, a different kind of risk is being tackled in our everyday gadgets. The portable power bank in your bag has become such a fire risk that it's been the subject of recall after recall, even attracting the attention of the FAA. We've all seen the videos of lithium-ion batteries exploding when damaged, and this isn't a small problem. We're talking about millions of devices. Anchor recently had to recall over 1 million of their power banks after reports of fires and even minor injuries. Belkin had to do the same. This has regulators on high alert, with agencies like the Consumer Product Safety Commission documenting incident after incident, setting the stage for a massive change. But now, a new company called BMX, founded by the same person who created the hyper accessories long adored by Apple users, is dropping a potential game changer. They're called solid safe power banks, and the company claims they use a new semi-solid state battery technology. So what does semi-solid state actually mean? Well, the name is a bit of a marketing game. A true solid state battery, the holy grail of battery tech, uses a completely solid material to move ions back and forth. That technology is still incredibly difficult and expensive to mass produce. What BMX is using is a clever hybrid. It uses a gel-like electrolyte, which is much more stable and less flammable than the fully liquid electrolyte in the battery you probably have right now. It's a bridge to the future. While they aren't truly solid state, the difference is staggering. Videos show these new batteries getting drilled, bent, and cut without bursting into flames. Compare that to traditional batteries, which erupt in fire under the same stress, and the promised longevity is impressive. BMX says these new power banks can be recharged over twice as many times before they degrade. The catch, they cost about twice as much, with prices starting at $79. This all sets up a clear conflict in the market. The industry is plagued with safety recalls and dangerous failures. BMX is entering with a product that directly addresses that fear. The founder is Accessory Royalty, and the technology appears to solve a very real problem. However, if you zoom out, you'll see another layer of strategy at play. The power bank market is becoming a low-stakes testbed for the exact same battery technology that could one day power your electric car. Think about it. It's much easier and cheaper to test and gather safety data on a small power bank than a massive EV battery pack. In fact, companies like NIO are already putting semi-solid state batteries in their cars in China, getting over 600 miles of range in real-world tests. This little power bank is a preview of a much bigger revolution. There is a trade-off. The chargers are stuck on the older 15-watt Qi 2 MagSafe compatible standard, not the newer 25-watt version. But the core proposition is what's turning heads. For a premium price, you get a battery that lasts over twice as long and, most importantly, is engineered not to become a fire hazard in your pocket. If this technology proves itself, it could force regulators like the FAA to create a whole new higher safety standard, potentially even restricting older, more dangerous battery types on flights in the future. We were just talking about new tech making our devices safer on the ground. Now, let's look up where a high-tech failure is, creating a massive new risk in orbit. A SpaceX Starlink satellite has just exploded. SpaceX has lost control. The satellite is now falling back to Earth after what the company calls an anomaly. But the details suggest something far more dramatic. A sudden loss of communication, a rapid 4-kilometer drop in altitude, and the venting of its propulsion tank. An independent space tracking company, Leo Labs, confirms its radar detected tens of objects breaking away from the satellite. Their analysis points to an internal energetic source, meaning it blew up from the inside. It was not a collision. When they say internal energetic source, they're likely talking about the satellite's own propulsion system. Starlink satellites use something called a Hall effect thruster, which shoots out charged particles of krypton or argon gas to move around. It's incredibly efficient, but it's not foolproof. A propellant leak, an electrical short, or a system failure could turn that thruster into a small bomb. The concerning part is that one single failure point could be present in thousands of these mass-produced satellites. This explosion also comes just 1 week after SpaceX reported a near miss between another Starlink satellite and a Chinese satellite. When a private company's satellite creates a field of debris, the consequences are huge. Under the International Liability Convention, the country that launched the satellite, in this case, the United States, is held absolutely liable for any damage caused. That puts the pressure right back on companies like SpaceX to prevent these incidents, because one bad day in orbit could lead to a massive international and financial crisis. What really brought this to a head was the next development in an increasingly crowded region of space, where over 24,000 objects, including satellites and debris, are currently being tracked. That number is set to explode. By the end of this decade, there could be as many as 70,000 satellites operating in that exact same region, launched by private companies and governments in the US, China, and Europe. While SpaceX says the debris from this one satellite will burn up safely, the incident shines a spotlight on a high-stakes reality. The global race to build massive space internet constellations is rapidly turning low Earth orbit into a congested highway, increasing the odds that a single failure could cascade into a much larger problem. This larger problem has a name: the Kessler syndrome. It's a nightmare scenario where the density of objects in orbit becomes so high that a single collision sets off a chain reaction. Each crash creates more debris, which in turn causes more crashes until low Earth orbit becomes a lethal, unusable minefield. The situation presents a fascinating duality. Experts used to worry about rare big collisions like two large satellites hitting each other, but now with mega constellations, the risk is shifting. The new danger is frequent: small explosions from individual satellites within a fleet of thousands. Research models predict that if we continue on this path, the number of debris objects could nearly double, making the onset of a Kessler cascade far more likely.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.